Hello, everybody. I'm Toby Shifsky with Kaplan Real Estate Education, and you're visiting with us on our Real Experts presentations. This is where we bring you the most current and timely information available in the marketplace that affects you and your jobs as real estate experts. And today with us, we have our real expert, and his name is John Mackey. And John is one of the foremost authorities in the United States on credit and credit scoring and debt collection defense. So he is the founder of Credit Genie.
Correct.
.us and is a Master Credit Solutions, also
Former company,
U.S. Credit Project, and Give Me Credit Media.
Correct.
That's correct. John is a former radio show host, so I'm hoping he has the chops today to carry the day. And that show was Give Me Credit.
Correct.
So we're seeing a theme here. Once again, John is one of the foremost experts on credit scoring, and credit defense in the U.S. And for us, with a real heavy slant towards real estate experts, people in the field working with customers today. The good news is John also has a real estate background. In fact, 22 years as a realtor and broker.
Correct.
And here's the other added piece. What I really like about this is you also bring in a mortgage loan originator perspective as a mortgage loan originator for 10 years.
Correct.
So you've got both sides of the real estate transaction piece, with the agent perspective and the originator perspective, and dealing directly with the clients, right? These people who are giving a mortgage, getting a loan in order to actually secure a home and a property.
Yeah, most of the business that I did on the real estate side, I'm kind of a contrarian in that everybody told me to be a listing agent, and I wasn't. And I did 22 years, 85% of the business was done with buyers. So, wow. So I am quite familiar with the buying side, to include the mortgage end. And that's what drove me into the mortgage end of it, because there was so much misinformation out there. And I just felt that people needed to know what the truth was, and I still do.
Yeah,
that's why I do what I do. Right
on. Well, thank you for being here today.
You're welcome, and thank you for having me.
Absolutely. So today's format, we're going to be discussing. We have about 30 minutes here, and so we're going to hit kind of some really hard-hitting topics. And there's a little bit of knowledge we're going to impart at the very beginning about credit scores, because I've been dealing with education, and I've had courses done on credit scores. And I got to tell you, I still don't fully understand credit scores. And so we're going to get a little primer on credit scores from John. So we're going to all be a little bit smarter about how they are actually calculated and how they actually impact almost anything that anybody extends any credit to us for is going to look at your FICO score, right?
Yeah. I had a friend of mine, and I love him dearly. His name is Prince, and no, it's not the Prince that we all think about.
God rest his soul.
Yeah. And Prince comes from a country called Liberia, and he came as a child. But one of the things that he told me was that when I came to this country, I thought money was everything. I thought that's what's needed to make it in America. And then as I grew up as an adult, he said, it's not money, it's credit. And I said, you found out, it's your score. That is a basis for where you live, what you do, maybe even where you work, what kind of jobs you have, the insurance you pay, the homes you buy, the neighborhoods you live in.
Oh, yeah. Yeah, it's scary, really, how much it permeates just about everything we do. Personally, myself, even, the role I have at Kaplan, I have access to information and records and people's personal information that I actually, as a part of our, security, we have to pass, background check. And part of what they search for is, are you, what's your FICO score? And so,
isn't that amazing?
I know it's scary, but we're going to cover that.
Right.
And we're going to do a little primer. And then we're going to talk about kind of what is happening today, because the title of this is obviously major economic disasters. Disruptors, and the impact really on credit. And today, I think our major economic disruptor is COVID-19 as of right now.
That's the primary one.
I think it's the primary
but
one.
But it is I don't want to even say a close second. It's a distant second. But it's finances, how it's affecting people's finances.
That's
people not working, people working part-time at less than a great wage. So how do they make their payments? And then when the credit scores come in and how this COVID virus is affecting that is what people don't know.
Right. And so we're gonna cover that, and we're gonna cover kind of some sneaky, scary stuff that's happening out there right now as some of these credit these people who are extending credit card companies, loan companies, they're changing the game without your knowledge.
Correct.
They're changing your credit availability without your knowledge. And what we're finding is that it's impacting closings. It's impacting people's ability. It's impacting their scores, their credit scores.
Correct.
100, 150 points overnight, unbeknownst to anybody.
That is
so
correct.
We're going to cover that. And then we're going to cover kind of the what else is happening and starting to play into how people are managing, people who are out of work, people who don't have money coming in. How are they managing their existing living facilities, right? Their existing mortgage. Are they making payments? And what are the tools available to them to maybe? We're going to talk about forbearance. How do you call your mortgage company and say, listen, I'm not going to make my payments?
Correct.
And how do you stop that foreclosure process? And so we're going to talk about forbearance, and we're going to talk about that process and what's available through the CARES Act, right? And
Correct.
Some protections that are in place for people to be able to do this and maybe get up to a year of not having to make a payment on their house. Now, we were going to find out that it might impact them greatly, even though it's not supposed to. We're going to talk about what's actually happening and how people may be being impacted by that when they didn't think they were. So forbearance, and we're going to talk about long range. What's happening. So we have the immediate, we have the mid range, and then long range. Right? What do we see on the horizon? And we don't have a crystal ball, but we got decades of smarts here. And so we're going to talk about how does this really impact, maybe even talk about property values. Maybe we talk about credit scores for people in the future and how credit scores are going to have to be calculated. Because one of the interesting things I think we found out, or I did in prepping for this, is there isn't just one FICO score. There's 10 FICO scores?
Well, there's actually many more than that. But in general, we're looking at FICO 2, FICO 3, FICO 4, 5, 6, 7, 8, 9, and 10. And then within those, because those are general scores, so if you go onto a credit monitoring service, they're going to give you a FICO 8. But when you purchase a home, it's balanced towards your home purchase. If you're getting a credit card, it's balanced towards getting a credit card. Or if it's insurance, it's balanced that way. So there are many. There's been estimates that there are 100 different scores. But in general, we're looking at the FICO 1 or FICO 2 through FICO 10.
Got it. So much information. We're not going to be able to delve all the way in and have specific questions, but John does have his email information available to us. We'll put it up again at the end, and you'll be able to send any direct questions to John if you want to. If you need that kind of expertise, just we'll have it to you, and we'll make sure you get it, and you can contact John directly. But let's go ahead, in the interest of time, and jump in, because these major economic disruptors, right, and the impact on credit, we're all going to be affected. Every single one of us, period. Even if, like my father, it's funny you talk about the prince that came that said it's not cash that's king, it's credit that's king. And for my family, I remember when my father had to go in for a first home loan, and he bought everything with cash and was shocked when they said, you don't qualify. What are you talking about? So here's the thing. Even us who think we live in a cash world, who maybe Gen X and Gen Y people are thinking they're in a cash world because they have no established credit at all.
Correct.
Right? So let's talk a little bit about how credit scores kind of affect our everyday life. And maybe we should just talk a quick primer about how credit score is kind of calculated. What is it? And then how does it affect our everyday life?
Okay. A credit score is basically a factor that defines based on what credit you've had, and balances out certain things like lates, how long you've had credit. So being young hurts you.
There's an algorithm, right? I mean,
that was the word I was looking for.
Yes.
That I was stumbling for. So I'm not such a genius anyway. So it's an algorithm that determines, and it's a 3-digit number that determines basically to an investor how well you are predicted to pay your bills in the future based on past performance.
Based on past performance. Okay. So how you've done in the past is an indicator of how you're going to do in the future.
That's what they say.
That's what they say. Now, clearly, when there's a giant major economic disruptor, it's like all bets are off.
That's right.
And so we're gonna talk about that in a little bit.
Because creditors change things.
Because creditors change things instantly because it's a major event, right?
Right.
All right. So let's go back to the credit score.
Okay.
And what's the range on a credit score? Because some people say, I've got an 800 credit score, and some people say I've got a 690, and a lot of people are talking mortgage in the mortgage industry. Listen, you need a 680 or better in order to get a loan for a mortgage.
Right. And that's one of the misnomers is that there have been a lot of advertisements out there that indicate, okay, what is your credit score? And you know who I'm talking about, but we'll mention them later. Yeah. What is your credit score? Well, your credit score, you don't have one, you've got 3, at least for a home loan. So for a home loan, understand there's not one credit score, there are 3. So which one do they use?
Who determines a credit score? I mean, who tells you what's in your credit score? Is it those 3 companies or what?
FICO is who determines the credit score based on what the information is in your Experian report. Experian is the first, it's the largest. Equifax, second largest, and TransUnion, third largest.
Okay.
So they're the 3 major ones. Please understand, not necessarily for financial purposes, but there are 40 others that are dictated. Now, we won't go into those because they have to do with a lot of other factors.
Right.
So Experian uses a FICO score, just as Equifax has hired out FICO to determine the score.
Okay.
Same thing with TransUnion. But, and here's the caveat that most people don't know, is that one bureau uses a FICO 2. Remember when I said 2, 4, 5, 6, 7, 8, 9, 10. Okay.
Sure.
When you pull a credit score on a credit monitoring service, they're going to show you a FICO 8, a generic FICO 8. Okay.
So one of those services out there that sends you an email says, get your
www.experian.com,
you're going to get
creditchecktotal.com.
a FICO 8, which is not what mortgage lenders use.
That's the point.
Okay.
Experian uses 1, and forgive me, but I forget which one they use. But one of them uses FICO 2, one of them uses FICO 4, one of them uses FICO 5. So if you ever wonder why, if you have an identical record on your credit report, why you've got 3 different scores.
So why each company doesn't come up with the same score.
They will balance what's on your credit report differently.
Okay. So they have different algorithms. So those FICO 1, FICO 2, 4, 5 use a different algorithm.
Correct.
Right? Whichever they think is important. Right? So they all got their own opinions on what they think is important that should go into your FICO score.
Correct.
Okay. So if I'm going to go out and I'm going to get a loan on a property, and what do I need to have as a FICO score today? And let's just give me the generic FICO score kind of approach. What do I need to have?
Again, an interesting misnomer that we haven't gone over. It's FHA is the biggest lender specifically for people with lower incomes. It's the introductory.
Sure. First-time home buyers, homes up to $400,000. I think it depends on region,
regions, communities. Okay. There are lenders that will say, okay, for XYZ mortgage company, you need a 640.
Yeah.
Another one you go to says ABC says, well, I can get them down to 620.
So
and
it's
then there
really
are some.
is it the investor that says what the credit score needs to be?
It's not the originator.
Okay.
It's the secondary market.
Okay.
Whoever they're selling their loans to determine that score.
All right.
Okay.
So what's the lowest you've ever heard for a FHA currently?
FHA, the lowest that they will go, and it's really not dictated by FHA.
Okay.
The lowest I've seen is 580.
580.
580.
Okay. And what's a great or brilliant credit score? Like if I'm going to go home and tell my mom you did everything right, I've learned, I'm beautiful, I make all my payments. What is a brilliant?
How old are you?
I'm 50.
Not only just in the generic.
Oh, okay. Me. I'm thinking me. Okay. Let's say I'm 35. Okay.
You're not going to have as long a history.
Okay.
Because that's going to be a factor. Now, history. If you had an 800 score, it would be fantastic.
That's shiny star.
850 is max.
850 is max. All right. I'm competitive. Going for the 850. All right. So 800, right. I'm a shining star.
Right.
Okay. And at 800, right? And we're just going to tie up this little section.
You can buy anything.
And I can buy anything pretty much, right? I walk in and they're like, oh, shining star, you're golden.
Right.
Right. And what if my 800 dropped to 650 overnight? What would happen to me as a 35-year-old?
Remember the show Gomer Pyle?
Gomer Pyle.
Remember that?
You'd be dating me, but yes, I do remember that.
So did I. Surprise, surprise, surprise.
Surprise, surprise.
It's going down, and you're not going to be able to buy as much.
Yeah.
With that 650. Now, are you going to be able to qualify for an FHA loan?
Sure.
Yes. A conventional loan? Absolutely not.
Oh.
Okay.
So what do I need for a conventional loan, you think?
Conventional used to be typically 680.
Yeah.
There were some that said 700, the others that said 710.
Okay.
Should we get into the other about how they're going up?
Yeah, give me some of this, how they're going up.
Okay.
This is a part of what's happening right now in the marketplace, right? So now we've kind of established these levels.
Parameters.
We're
work
right?
around.
Stuff's happening in the market right now, and they're changing the parameters. So what you're going to find is we've actually got lenders changing the parameters, these secondary market purchasers, investors, changing the parameters up. And at the same time, the institutions are changing other bits of the game that are actually negatively affecting your credit score.
That's correct.
So stuff is happening without your knowledge that's going to lower your credit score, may lower your credit score, and investors are asking for a higher credit score. So
my prediction.
Yeah, go ahead.
I'm like a politician. I'm just going to make up a statistic all at once here. 91% of the population is going to have a credit score drop. Okay?
91% of us
correct
are going to have our credit score drop.
Correct. Period. Now, if it affects you in your purchasing power is another story.
Okay.
Because there are thresholds. Okay. So if you had hypothetically a 640 score, you could get that loan. If you had a 639 score, you couldn't.
Oh, okay.
Because if it goes through manual underwriting, depending upon other factors, that 1 point can make a difference.
Okay. So what's happening on conventional loans?
Conventional loans, they are now typically, they said they needed, for example, JP Morgan Chase just went from requiring 10% down up to 20% down.
Oh.
Okay. That's a big chunk of change. Just doubling what you need.
Got it. And the reason they're doing that is because they feel there's more risk in the marketplace.
They're protecting themselves.
Got it.
Okay.
Got it.
And now you've got the FICO score. Thank you. The FICO score minimum is gone from 680 to 720.
So So for conventional, two
Correct.
things happen. You're seeing JP Morgan Chase, just one investor in the conventional mortgage market,
Correct.
says, hey, we're not taking 10% down anymore. You need 20% down. And oh, by the way, your credit score can't be 680. It's got to be 720. Something like that, right? And so that's going to be, it's obviously going to be, now interest rates right now
are extremely low.
Because we always think it's about interest rates. Well, no, like your prince said, credit is king. and
That's
either
right.
you qualify or you don't. So that's number one. So let's I think we've kind of covered the FICO score as deep as we're going to probably be able to go, because I got some hot
Let's go.
items here I want to be able to get in. Once again, if you have any questions for John, you can email him afterwards. Would love to do that. Couple things. What's happening right now in the credit industry? And in fact, I'm just going to cut right to it. I'm going to talk about credit cards, because credit cards are a big part of calculating your credit worthiness, right?
It's the second most important item on your credit report.
Did you tell me it was like 30% of your
30% of your score is based on your credit ratio.
credit ratio?
Credit ratio is defined as what your maximum balance, or what your amount that you've borrowed against your maximum balance.
So if I have a $10,000 line on my credit card,
Right.
and I have $5,000 that I've used,
Correct.
right? I've got a 50% credit ratio.
Correct.
Okay, got
Correct. Just to reiterate, the best score for this, where it doesn't have any effect at all, your ratio, is when you get it under 15%. 15%.
15%. So if you
Okay.
carry under 15% ratio,
Right.
on average,
Correct.
that's golden, because it's showing that you can actually make a payment on
There you go.
credit, right? So having a zero balance isn't great either then, if you never use the card.
Well, but what happens if you pay it off ahead of time?
Okay.
So you're still creating that zero balance.
Okay.
The problem is with that, especially in this new scenario where the creditor could actually close that account because they're not making any money on you because you're not paying any interest. It used to be that was okay.
Okay.
That could become a huge factor if that is your oldest card, because they take a look at credit ratios in total, meaning all of your credit cards or your HELOCs or whatever.
Are you saying that the credit card companies are closing cards if you have a zero balance?
Yes.
And they're doing that right now?
Yes.
That's
As a result of this.
Really?
Yes.
So you think you're doing awesome because you've got your balances paid off on your credit card, and the credit card companies say, we're shutting down credit. And For you. And they shut the card off, and it's an old card. You've had it for years. And that weight comes off of your FICO calculation, which is based on credit.
Longevity of credit, which is the third portion of your score. But right now we're talking about the one of the 30%.
So earlier we did talk earlier. I wanted to just, because there's another part to this that I think people need to understand.
Bring me back.
They're not so number one, they could actually be canceling your credit card, and that could affect you. No, you don't even have an option. They're just like zero balance.
You're
shut
done.
it off. Second, they can actually, you told me, lower your credit availability. So remember that.
Correct.
So let's use the example. I have the $10,000 credit card.
Correct.
I carry a $5,000 balance.
Correct.
Right. And I'm making my minimum payment and I'm doing my stuff. And maybe I drop a little bit more, a little bit less, or maybe I'm using it every month. But I got a $10,000 limit. I got $5,000 on the card. And what are credit card companies doing right now that is negatively affecting your credit score? What are they doing?
They're dropping the limit.
So you no longer have a
$10,000. They could drop it all the way down to $5,000. Now you've increased your ratio from 50% to 100%, which is a huge score drop. Okay.
How much? Like if they did that to me?
100 points.
100 points. I go from Shining Star 800 to a 700. I can't even get a conventional loan. 720 for a conventional loan.
Correct.
There'd have to be a lot of work for me to get a conventional loan.
Right.
But I have to pay an extra 20% down on now. So
not only that, but what you could do to rectify that would be to change the $5,000 balance, bring it down to, let's say, 1,000.
Yeah.
Now you've increased your score back again. So you can rectify that.
You have to rectify it, but you have to do it within a certain amount of time. Right? I mean,
no, because you could do it in 2 months. Your score is going to be low for those 2 months.
Your score's already hit. I mean, as soon as they lower it down and you got the balance. So checking your credit cards and what your credit card companies do, you all get those statements, right? And we don't always open them up to see what the heck's going on, but they're gonna tell you they're lowering it, right?
That's right.
They have to tell you need to be aware those balances need to be lowered. Otherwise, what happens is your credit score takes a hit and you thought you were golden, shining star, 800.
That's right.
Right. I told you before, I had the same situation back in the Great Recession, the financial meltdowns of 2008, 9. I had a home equity line, and we were lining up to do a $200,000 home remodel, and it had all lined up, and the credit line lender shut the line off. And they said, your whole area is in an economically depressed zone. We're shutting you off. That wasn't me. I thought I was an 800, gold star shining person. And thank goodness we didn't have the work started already, because think of the lien, situation and the contractor and not being able to pay them. And so awesome. I know we're coming up on time, but I did want to talk about a little bit about kind of what happens in the situation where people are they're crushed, right? 20 million Americans out of work. They're not making payments, right? Like, right. What do you think? What percentage of people are not making mortgage payments right now? Do you have a guess?
It's in the 30% range.
Not making mortgage payments.
So you're into the forbearance, which we don't have a whole lot of time to be talking about.
Right.
But that's a big issue.
It is. So understand this. Somebody doesn't make the mortgage payment, you go into default, you have to cure the default. Now we're back to short sales, foreclosures like before. Now in the CARES Act, there's actually some protection in here. And
correct.
And in the CARES Act that was passed for this whole coronavirus, relief fund, and that CARES Act allows for a homeowner to request of their mortgage company forbearance.
Forbearance, meaning from that point forward, you do not have to make the payment. They have to continue to mark your credit report as being paid.
So you contact your mortgage company, you say, listen,
yes.
I can't make the payment. They say, okay, and you work out. There's a couple different ways to do the workout, how you're going to actually, you still have to pay the money, but they're going to suspend, essentially, or almost abate having to pay right then. And you figure it out. It may be you move it all out a year. I can't pay for a year.
Correct.
I shift everything out and I add a year to my home loan.
Correct.
But I still have to, interest will be ticking and I have to pay that. But the real key here in the CARES Act is, in order to protect your credit score, they're actually not going to report you as missing a payment, right? They're going to report you as current. But the problem is,
caveat,
yeah,
is that they've found a way around that. Is in the narrative of the credit report, they're going to put in there in forbearance, which means you can't get another loan during that time.
So you think you're doing the right thing? You think you're protected by the CARES Act?
Be very careful of it.
Yep. You go and you ask for forbearance. So how would you recommend people handle that if they have to go in and ask for forbearance and they shift their payments and they don't make any payments and they think their credit's all fine, but there's this note section, right, that's being filled. How do they make sure that doesn't happen?
Well, in the short amount of time we have right now, I would suggest emailing me and I'll help out based on individual scenarios, because there are 4 different ways to pay it back. Each one is a different scenario.
How long from when it doesn't in the credit report, it's not affecting their credit score, but it's in the notes, how long do you think somebody would have to go before any lender would give them a new loan?
12 months.
12 months. Hidden.
So you could have the forbearance for 12 months, and at that point, the timeline starts. And then it goes another 12 months.
So another 12. So for somebody could have a 12-month forbearance, and it would be another 12 months at the end of that time period.
Correct.
Before they could ever buy another home. So this will impact people.
Absolutely.
Remember, over 30% of mortgages right now not being paid, people taking advantage of forbearance. We're all going to become really smart about forbearance and its effects on purchasing a home. John, I wish we had three more hours. I'm sure our people wish they had 3 more hours. I wanted to thank you again for coming to Kaplan and being a part of our Real Experts program. We're going to need to have you back.
I'd love to come
we're going
back.
To have questions.
Tomorrow, what time you got?
Yeah, very good. All right, everybody. I want to say thank you for joining us, and we look forward to seeing you again.